Before we get started with this episode, I would just like to shout out Woodsman TA Keck, where on my Barrett Gold video, he's put a comment saying, I think you need to add assets on books to your analysis of miners. Actually, not just miners. I decided that I'm going to do this for all companies moving on. I'm going to add assets and compare them to the liabilities. All right. So thank you very much for the comment, and let's get started with this episode. Hi there everybody, and welcome to another stock analysis video. Today we are going to be analyzing ADP, the payment processing company. Honestly, this company is one that I really would like to buy in because I think that they are pretty prominent, especially when it comes to the payment processing. I don't really know of any other one, or at least it's not that there aren't other ones, it's just that they're not as prevalent as ADP. So we're going to do an analysis and see how the current stock price actually matches with its fundamentals. So with that said, let's get started with this analysis. Starting off, we got the dividend summary. ADP actually has a pretty decent dividend for all those dividend investors out there. Dividend yield of 1.82, which ends up being $1.04 per share for an annual payout of $4.16. Payout ratio in regards to the net income is around 61.46%, which is a little bit high. However, this is in relationship to the net income. We're going to take a look at this in regards to the cash flow in just 1 second. The 5-year growth rate on this dividend is 12.14, so it's very, very high. And they have consecutively grown this dividend for 23 consecutive years, 2 more years, and they have the title of Dividend Aristocrat in the S&P 500. Ex-dividend date is coming up on March 10th. Payout date is on April Fools, and they pay their dividends quarterly. Now coming over here to the calculator, we got the ticker symbol ADP. Market cap of $96.4 billion, PE of 36.18, which is a little bit high. Again, we want to buy anything under 20, 36 is definitely high. One metric, does this mean that we don't buy it? Not necessarily. We're going to take a look at others to see if this company is even worth buying. For all we know, their fundamentals may be trash. Share price of $228, and as we saw, they pay a $4.16 dividend per share annually, which ends up being around $1.8 billion being paid out in dividends every single year. This in relationship to their free cash flow, they're only left with $742 million in free cash flow after this is paid, meaning that the payout ratio in regards to the cash flow is 70.28%, which is very, very high, guys. They're really cutting it close with the amount of cash flow that they have left and this dividend. Unless they increase their cash flow, they will soon not be able to pay this dividend in the future or even be able to increase it. Now coming over here to the fundamentals, we got the net income 5 years ago of $1.8 billion to 1 year ago of $2.6 billion, which is an increase of 45%. Next, we got the free cash flow 5 years ago of $1.9 billion to $2.9 billion, which is an increase of 55% with an average 5-year free cash flow of only $2.5 billion. The cash flow is very, very steadily going up. However, in relationship to this dividend that they're paying, either they need to increase it significantly higher or they need to cut down this dividend in order to afford it a little bit more. Because remember, companies do a lot of things with their free cash flow. They pay down dividends, they make acquisitions, they pay down debt, then reinvest in themselves. So if they are putting out majority of their cash flow into dividends, that means that they don't really have a lot of wiggle room to invest in themselves or make acquisitions. So that's just something to note when it comes to looking at the cash flow. Next, we got the revenue. 5 years ago of $12.4 billion to 1 year ago of $15 billion, which is an increase of 21.29%. It is looking very, very steadily when it comes to this line, and seeing this, I believe that my assumptions are going to be correct into the future. Next, we got the new metric, guys. As y'all saw in the intro, somebody in my Barrett Gold video mentioned that, hey, maybe I should take a look at the assets on hand. And he mainly just said that for miners. I'm going to look at that for all companies. I actually put now in my fundamentals, like where I actually put in the numbers, total assets and then total liabilities of the company, and then I added them both. So this chart that you see right here, it is the total assets minus the total liabilities. Because of that comment, I actually found out that debt is a subsidiary to liabilities. So therefore, there really is no need to take a look at total debt if we have the total liabilities. And obviously, just looking at liabilities alone doesn't really tell you much. You want to know if they're even able to afford their liabilities. So I took the total assets and I took the total liabilities and I added them both to get this chart. So what we are getting is that as of today, they have $2.4 billion more after paying out their total liabilities, meaning that if they were to sell all their total assets, they'd be able to fully pay their total liabilities and still have $2.4 billion left. Over here, I've taken the average of their total assets, which is around $37.2 billion, their total liabilities, which is $35.1 billion, and subtracting these two averages pretty much just tells you that they have had around $2 billion left if they were to sell all their assets and pay all their liabilities with these assets for the current year and even the prior 5 years. So this alone tells you that they are 100% able to cover all their liabilities with their assets alone. Next, we got the shares outstanding, a metric that a lot of people tend to overlook. This tells you whether or not the company is diluting you as the investor or not. You want this to be going down. And ADP 5 years ago, they had 445 million shares to today of 422 million shares, which is a decrease, guys, of 5.45%, which is very, very healthy to see. And it's actually pretty interesting to see that even with paying this dividend and this dividend being so incredibly tight to their free cash flow, they're still able to buy back at around 5.5% of their shares outstanding back. Lastly, we got cash and equivalents. And as of today, they have $1.6 billion in cash and equivalents, with an average cash and equivalents around $2.2 billion. Now let's make a low, medium, and high assumption depending on how much we think this company is going to grow into the future. I'm going to keep the required rate of return the same at around 10%, match the S&P 500, and I'm only going to be changing the growth assumption. For the low assumption, I'm going to say a growth of around 5%. This comes out to be a target share price not adjusting for debt of $94.95. For the median assumption, I'm going to say a growth of 7%. This comes out to be $101.73. And for the high assumption, the growth would be 10%, which comes out to be a target share price of $112.53. Now we're going to adjust for debt. And just because I'm not showing the debt in my graphs anymore doesn't necessarily mean that we can't use it. Actually, we must use it to adjust for debt. The way that we adjust for debt is we take the net debt and we add the cash on hand, the cash equivalents with it, and then we put this into the total market cap of the company. If they have more net debt than cash, then that means that the value is going to go down. If they have more cash than debt, then their value is going to go up. This is essentially how we come up with this number. So the target share price after debt for the low assumption is $90.61. For the median assumption, we get $97.35. And for the high assumption, we get $108.50. Adding a margin of safety of 5, 10, and 15%, we would like to buy this. For the low assumption, we would like to buy between $77 and $86. For the median assumption, $82 and $92. And for the high assumption, $91, essentially $92 and $102. Guys, the current share price is $228. So even with my highest assumption here, not even adjusting for debt, we are still way under the current share price to justify buying this, right? We are taking all of their fundamentals, and as you saw, yes, they have good fundamentals. However, when it comes to the end of it, you are essentially overpaying for this company at $228. And the PE even says so. Buying a company with a PE of under 20, this one's currently 36.18. It's pretty much telling you that, yeah, this company does need to drop by a significant amount, $100+ in order to justify buying this company, which means that my assumptions are in the correct ballpark. But then again, those are just my assumptions. If you believe that ADP is going to be awesome, maybe you don't agree with my growth assumptions, maybe you would like a higher or lower required rate of return, I highly suggest you get this calculator and you make these assumptions yourself. I will be updating the discounted free cash flow calculator in order to take off the total debt and to just add the total assets, total liabilities, and then the addition of both. So be on the lookout for that. By the end of this video, by the time this video goes out, I should have it all good. Pretty much nothing changes, just you have to take a look for total assets and total liabilities, and then the calculator will do everything by itself. But that's pretty much it for this episode. Like if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You can follow me on my new tech sites at BitChute, Odyssey, and Rumble. In addition to my stock analysis videos and crypto videos, you will find exclusives as well. So with that said, peace out. I'm on the lookout for the next stock analysis video.